hard. And then 2 adults on the ice.
No.
Everywhere here, they're like
32.
sorry, that's funny.
Gavin and Hayden.
That's what the scary
Yeah.
Okay.
He's not making a joke, he's serious about it, I think.
That's just and it's like
Dang it.
So anyway, if your score isn't in the grade book updated, it's because there's still a few left on my desk. I did not have time last night to do any. I got some during sun power yesterday, but I'll get the rest finished today. Maybe during Metro Soccer. I have not updated the canvas yet because it depends on how far we get today. I don't, at this point in time, this minute, I don't think we'll have the quiz tomorrow, but we'll see how this goes. So here we go. Except,
oh god.
there we go. All right. So, things that influence our net exports, and boy, oh boy, with all this stuff going on with China and the contents of this chapter, if you can't come up with a current events article this week, you just ain't even trying. Okay. Do we like the foreign goods? Do we prefer them? Do they have the nicest stuff that you want? Are domestic goods too expensive? Are domestic goods less expensive than foreign goods in those foreign countries? And some of that, a great deal of that actually depends upon the exchange rates and the strength of the relative currencies. So is what they say is the dollar strong, meaning does it retain high value when compared to foreign goods? Are consumers, both domestic and foreign, making good money?
Oh. Emmanuel, you totally thought it was you.
Yes, he did.
No, it's just a bookstore.
Oh, just a library.
So there's your exchange rate that I already mentioned. Transportation costs. Does it cost an arm and a leg to ship it overseas? Are oil costs high so that air freight is too expensive, or oil costs high so that sea freight is too expensive? And government policies, which we can interpret right here, right now as tariffs or quotas. Raise your hand if you have not heard about tariffs on America imposing tariffs on foreign goods, especially China. Okay. Hopefully. China. All right. Net exports measures the imbalance in a country's trade in goods and services, as well as, or goods as well as services. Okay. It is this trade deficit which has got President Trump upset and spurred him to impose the tariffs on China. So we're running a trade deficit, meaning we import way more than we export. China, thus, has a trade surplus with the United States. Overall, as a whole, we run a trade deficit with the rest of the world. We import more foreign goods than we export domestically made goods. Yes?
How much is the economy of Nebraska going to be hurt?
How much is the economy of Nebraska going to be hurt? I don't know, because you just specifically mentioned pork. But what you missed was that overnight, the Chinese also added soybeans, which is one of the single largest Chinese imports of agricultural goods. I don't know. We'll have to see how far this goes. A lot of the tariffs that President Trump announced have not gone into effect. The White House is on record this morning as saying that some of them may never go into effect. We'll have to see. The Chinese retaliatory tariffs have been kind of limited. So they put tariffs on imports of airplanes. Well, who's our largest air manufacturer in the U.S.? Boeing. And the 737X, the newest, biggest one, is like 74,000 kilotons or something, or whatever the measurement is. 74,000 tons. The Chinese put tariffs on airframe imports from like 5,000 tons to 70,000 tons. So old airframes, but they're not putting a tariff on the new one that a lot of Chinese, the Chinese airlines have just been buying. So they're retaliating, but they're retaliating in. Okay, they put huge tariffs on imports of American-made cars, but General Motors has lots of manufacturing plants in China, which thus are domestically made and aren't subject to those tariffs. So, yeah, we'll have to see how it plays out. If you have a trade balance, it's when your exports equal your imports. For those of you who have ever dieted, think of this as being a balanced diet where you are burning as many calories as you are consuming and thus maintaining a steady weight. If you are gaining weight, you are running a diet surplus, or diet deficit actually. You're bringing more in than you're burning. Okay. All right. Over time, and here on the left-hand side of the graph should be 1960. Might be right. The U.S. economy has opened up, meaning we have traded more. Okay, so there's our export line. Why this sudden drop here after 2000?
Is that a dot-com bubble?
What?
Dot-com bubble?
No, the dot-com bubble was going on here, right before that. 9/11. When 9/11 happened, we kind of said to the rest of the world, we don't like you, we don't trust you, we're not doing anything. This more recent drop here, that is the general decline in our overall economy and the global decline in the economy as well. If folks domestically aren't buying stuff and we're laying people off and we're not producing stuff, we can't export it, and that global economic decline, one of the factors influencing trade was what are incomes abroad as well as domestically. They were hurt. There's our imports, and you'll notice that our imports dropped more than our exports dropped at that same point in time, 2008. Look at this big change, though, here in the mid-70s, where we went from exporting more than we imported to importing more than we export. You've heard me say before that we are no longer primarily a manufacturing economy, right? That's where we made that transition. Stopped making all of our stuff here. All right, net capital outflow. NCO is going to be an important abbreviation for you this chapter. Read it. It should make perfect sense. If Americans are buying more foreign stuff than foreigners are buying American stuff, our capital is flowing out. And this is, when it's saying capital outflow, what kind of money are we talking about? Investment money. This is when you're buying mutual funds and stocks overseas. You'll probably most commonly hear it referred to in the news as net foreign investment. Net capital outflow would be an economic and a finance term. common verbiage would call it net foreign investment. Two ways that we send our money overseas. We do that direct investment thing. Remember how we've talked about that? We go and you actually own and manage the asset in the country. That's about 3 chapters ago. Familiar? I saw some heads nod. Okay. And then the foreign portfolio investment, where you just create a pool of money and say to the country, here, do with it what you will, send some returns my way, please. Thank you. It's a golden ticket.
Can you escape the second
What? That was so much irony. I couldn't.
Oh, my heart. I can't do this anymore.
Do you truly volunteer as tribute, Andrew?
I was going through my head of all the things that she could be coming down there for. I was like, oh, no.
Now there's a sign of a good boy. He says, where is Dr. O'Hanlon's office? Never been.
Yeah, can't say
All right.
She has a line outside her door.
No, literally after like this period when you go, there's just like a little group of constants that just hangs out there. Next.
When NCO is greater than 0, we have what's called capital outflow, meaning our capital resources are leaving the country. It is good or it is bad. It depends upon your view of globalism and economics. If you believe that strong trading partners help strengthen your own domestic economy by creating an economy that can consume your exported goods, then you're okay with a net capital outflow. If you believe that only your nation should be strong, then you're not okay with this. When you have capital inflow, that means that foreign nations are investing in you. And you like that because then you have more money to use to improve your nation, but at the same time, what's the problem with it? Some share of those profits have to go back to those foreign nations, and they're being enriched by your growth. The bottom line is economically, when we know that trade makes everyone better off, we should be okay with however this goes, because theoretically, the money is going to go where it's going to do the most good, right? If we believe in true capitalism, the money's going to end up where it's going to best profit the investors, which means that it's going to have the greatest amount of growth. Because growth equals profit. All right. If you are going to get a poor rate of return on your investments in Zimbabwe and a great rate of return on your investments in Pakistan, where will you invest your money? In Pakistan. So the real rate of return on your foreign assets is what incentivizes you to invest in some countries and not in others. Things that impact that real rate of return, we've talked about. We talked about them in the chapter where we talked about ways to improve economic growth. How about a stable government? Laws that protect investments and property rights, etc. Remember that chapter? Okay. So places that are unstable, that are in the middle of conflict, that have corrupt governments, are going to offer you a poor real rate of return on your investment. What are you getting if you invest domestically? If the domestic asset rate is higher than the foreign asset rate, where are you going to invest? Yeah, you're going to invest domestically. Because we know that people will always act in their own best self-interest. Okay? what perceived risks are there in holding foreign assets? Perceived risks. Notice it says perceived versus real risks. Okay. We operate in a world where information is pretty readily available, but so is disinformation. Or what has, in the past couple of years, come to be known as fake news. Okay? So, if you are hearing that there might be a military junta in some country that you've been thinking about investing in, no matter how high the real return of investment is, are you likely to go ahead and write that check? Not so much, right? Not so much. So, Brazil has been in the news recently. Pretty risky, unstable government so far as the news is concerned. But if you look at the financial information, it's actually been a fairly profitable place to send your foreign investment dollars. So remember, perceived risk is not always the same as actual risk. What does this one mean in real English?
Will the government let you do it?
Not just will the government let you do it, but what do they do with the income that you get from those foreign dollars? Do they tax it at a higher rate? Do they tax it at a lower rate? Because remember, the government would probably rather that you be investing your dollars here. So right now, U.S. tax policy says that income earned on foreign investments is taxed at a higher rate than domestic income, thus increasing the disincentive for that foreign investment.
Is that so they want to invest more money here versus?
Right. But some of those foreign nations may be saying, hey, you know what, you earned money here, that's cool, we're glad to have had the investment. You go ahead and take all your profits back home tax-free. Well, that helps to offset, right? So you got to look at all of these influences. All right. An accounting identity.
Yes.
Net capital outflow should equal net exports. How many of you love accounting?
Stop.
She
Stop
does
it. Stop it. Stop
She's
it
a
right
bitch.
now.
You like
Stop.
accounting.
Jared probably loves it.
Hayden
Yeah.
loved it. Way too many
Lots of
mistakes.
stuff.
Hayden loves accounting.
Accounting is so
Being
easy.
a tax accountant is so
I hate it. I hate everything about it.
Hey, here comes Scott.
Oh no, everybody
Wait,
quiet.
everyone's silent. Give us the teeth.
I see no open wounds. He survived.
He came in smiling.
What happened?
How do you
Because it was dumb. I set my stuff down before class started to use the restroom, and Mr. Handler marked me absent. When I came back, and he didn't fix it. So
Oh my gosh.
come on, why are you
It happens.
One
It
time I was
happens.
so
All right. So you may have heard the old adage, two sides of the same coin. Think of net capital outflows and net exports. They're the same coin. One side is one side is the other. They are the same equation, so they have to be equal. When a foreigner purchases a good from the U.S. exports that good. So net exports go up, net capital inflow goes up by the same amount. Right? They can't buy a foreign good, they can't buy a U.S. good unless we've exported that good. So Yep. Got it? Kind of a huge duh. But just remember that accounting identity up there. It will save your bacon here. Okay, what is that equation known as in your mind? GDP. Because Y equals GDP. Okay, let's scramble it up. GDP minus consumption minus government spending is equal to investment plus net exports.
Wait.
Because algebra.
Yeah.
It's pretty simple, actually.
Can't you just subtract the then you add
Then you substitute.
boom.
Okay.
Whoa.
So S is now equal to GDP minus consumption minus government spending. So S is equal to investment plus net exports. So introducing a new letter for you.
S savings.
So S is equal to investment plus net capital outflows,
Wait for it.
since net exports equals net capital outflows.
Mankiw.
So when S is greater than investment, the excess loanable funds flow abroad in the form of positive net capital outflow. What is S? Savings! Thank you for drawing that conclusion.
Me?
Yeah.
You're welcome.
You're gonna have to know this. Did you say you already do?
No.
It just gets more confusing.
It was Dinoco.
S is the main letter.
When S is less than less than investment, we're getting net capital inflow. We're not relying on those foreign dollars. So what do we exist in right now? What's the United States operating with right now? Inflow or outflow?
Inflow.
What is our NX?
We have more imports than exports. That means they're buying our assets. We just inflow.
Inflow. For almost 40 years, we've been running pretty significant trade deficits. So this is where being an informed consumer of news will help you. Because there is some disinformation being propagated on both sides. Both Republicans and Democrats like to blame the other side for trade deficits, for changes in trade policies, et cetera, et cetera. But this goes back clear to the Reagan presidency. And a lot of it has to do with imports of one particular commodity. Oil.
Oh, it was oil.
Oil's
I was gonna say that too.
Prior to the oil embargo during the Carter administration, we were running in general trade surpluses. Combination of things resulted in a decrease of American oil production. Our easily accessible oil reserves kind of got used up, and so it became more costly to access the oil that still remained. Oil prices dropped after the oil embargo, and it became less profitable for American companies to produce oil. Environmental protections increased significantly, and it became more costly for American companies to produce that oil. And consumption increased a lot in the late 70s. We were driving gigantic, heavy, gas-guzzling vehicles and consuming tremendous amounts of oil to drive them. And fuel economy standards were put in place early in the Reagan administration, but those are always created with a large window of time to begin implementation. You can't say to Detroit, the automakers, You gotta have more fuel efficient engines. Next year, go! It takes them time to do the R&D and to get things changed in the manufacturing process. And so we didn't begin to see real fuel efficiency standards until the late 80s and early 90s. And by then, we pretty much solidified our trade deficit.
Boom, right there.
So, saving has to equal investment, right?
No.
Yes, because what you save, what you put in the bank, is what's there to be borrowed. So if saving doesn't equal investment domestically, where is that gap being made up?
Somewhere else.
Foreign dollars. Foreign dollars. What was that? Whoa.
Really low. 'Cause it went
Yeah,
from
-6.
Yeah.
Yeah, notice that this x-axis is not 0. 0's up here.
Yeah.
And look how this mirrors that. All right. Budget deficits, governmental budget deficits make a big difference as well. In the early 80s, actually throughout the Reagan presidency, the government increased its spending tremendously in what sector of government spending? National defense. Yep. Remember, President Reagan saw a way to break and to end the Cold War, and he did so simply by outspending the Soviet Union. He bankrupted them by spending more on national defense because we were in that mutually assured destruction, eye for an eye, missile for a missile kind of scenario. And if we built one, they had to build one. Whether that's an aircraft carrier or a submarine, missiles, long-distance bombers, whatever it was, they had to keep up. And the only way we could keep that spending going on was to run a tremendous budget deficit. We spent money we didn't have. Right there. During the Clinton years, the economy began to recover. We had huge growth. We had a few years where the budgets didn't run a deficit, where we had a balanced budget, and we actually paid down some of the national debt, in addition to not growing the deficit. And as such, savings domestically increased. National saving improved because the government wasn't crowding out of that market. So, is our trade deficit actually a problem? Is what's going on right now in what may or may not evolve into a trade war a real issue, or is it a pre-campaign issue? Because remember, politicians are already thinking about and looking at November. It's a congressional election. Trade deficits are not in and of themselves bad. Trade deficit exists because you have the ability to consume foreign goods, the willingness to consume the foreign goods, and the foreign nations are willing to trade with you and happy to take your money. So in and of itself, a trade deficit isn't a terrible thing. But the trade deficit could be the sniffles. And the sniffles can be a symptom of a bigger issue, right? Got a little lump. That could be your trade deficit. That lump could be nothing. It could be an infected pore, right? Or it could be a tumor. be a large cancerous mass in your economy. Noah. He literally is. All right. So, as of the new year 2010, foreigners owned $21.1 trillion worth of U.S. assets. That seems like a lot, doesn't it? You don't have a yardstick to compare that with. You have no idea if that's a lot or not. Don't be suckers.
Next.
Now do you have a yardstick? So foreigners own more U.S. assets than U.S. owned foreign assets. So what? Meh. Big deal, right? $2.7 trillion owed to foreign nations. Is that a problem?
Hi. Did you put that sign on there?
What's
Or did Rahajic on the copier?
Oh, it's been blowing up lately.
No, I know, but it doesn't work to copy, but if I scan stuff, would it work or no?
Scanning should theoretically work. The single-sided and double-sided copies are just getting eaten.
Okay, I'm just gonna go to a different place. Sorry to interrupt, thanks.
Walks in here like it's an old class.
Welcome to tech support. All right, so is it a problem that we owe the world $2.7 trillion?
Maybe.
No. Okay.
Do
So,
we just like write a big check?
who in here wants to be a doctor when they grow up? Somebody in here's gonna want to be a doctor. All right. Jonathan wants to be a doctor. Jonathan, what will be your total debt load by the time you get to wear the long white coat and overall practice? Hopefully no more. What is the possible lower limit? From what I understand, between 350 and 400,000.
Why 270?
So, will that be a problem? It could be.
Depends on-
It could be.
It depends.
It depends on what?
How much money you make.
How much earning potential does he have?
Well,
What kind of doctor? Right? Plastic surgeon,
School nurse.
400,000, no problem. Dermatologist, 400,000, no problem. Neurosurgeon, no problem. General practitioner, could be a problem. Could be a significant problem. Cosmetic dentist, no problem. General dentist, so earning potential, potential to pay back the debt matters. Okay, what else might matter? Who will he owe that to? If he's fortunate, the federal government, or all of them. If he's unfortunate, the federal government for some of it, and private banks for some of it. Why would that be unfortunate? Higher interest rate. And the federal government tends to work with you more on repayments. A private bank is going to say, all right, buddy, 10 years are up, your note is due, $180,000 right now, today. And any assets he's acquired at that point, his house, his car, his wife's car, the baby's crib,
Take the baby's crib.
the exam tables in his office, right?
Put your own house into an LLC.
So what happens if our foreign creditors come for this money? We got a problem. We got a problem. Who owns the majority of U.S. foreign debt, China. When you have a large amount of debt and you are slowly paying it down or just paying the interest as we're doing with a lot of our foreign debt, you often need to renegotiate the terms of those loans. So, Davis, you are my creditor, and I owe you $2 million. And the loan is coming due, and I come to you and I say, we need to renegotiate this loan, sir. Could we please possibly do that? If I'm on good terms with my creditor, we're gonna get something worked out. If I have just called my creditor fat, lazy, stupid, greedy, and a big bastard, and then I say, could we renegotiate the terms of that loan, sir?
I would be driving your Subaru.
Okay. If we've just said to our creditor, China, you're cheating us, you're robbing us, you've been treating us unfairly, we're going to get even, we're going to start restricting your ability to trade with us, and then we have to turn around and say, by the way, about those loans, work out an interest reduction, a longer term of payment, please. How's that gonna go? And foreign trade and financial policy, while handled by separate parts of the government, in diplomacy are all big parts of the one diplomatic puzzle. Right? How many of you have had a fight with your parents over something silly, right? And you slammed the door and shouted something at them that might have been unkind, along the lines of, I hate you forever, I wish I was never born in this family, right? I wish you'd just die. Ooh, that's cold. Yeah. I'm frightened that Noah just nodded at me.
No, he just laughed.
Alright. And then, like, 2 days later, in your mind, that's an endless amount of time. But then in your mind, you have to go to them and say, I need some money for dinner for prom and to buy a corsage, and by the way, I need an oil change, and the mechanic says I need new tires on the car too. How does that get received after you've just slammed the door in their face, told them you hate them forever, wish you'd never been born, and that they would hurry up and die? Yeah, right? So, even a month later, 2 months later, there may still be some hurt feelings. Well, in terms of nation states and diplomacy, 20 years, that stuff doesn't get forgotten. Oh, look at that bit of information. We owe more money than any other nation in the world. Right now, and remember right now in terms of our presentation in 2010, not 2017, we were earning more on our foreign investments than we were paying on our foreign debt. We were ahead in this game. But the more you borrow, the greater risk you are as a borrower, and the higher the interest rates go. And at this point in 2017, we are nearing the break-even point and ready to fall off the edge of that cliff, where we pay higher interest than we receive. All right, part of what factors into all of this is the exchange rate. Well, hello, Gavin. Welcome.
I pay someone to do all that.
There is no way we are having our test tomorrow. We will finish this chapter tomorrow. Very unfortunately, boys and girls, that means we have a Monday test. Because I can't drag it out another day. So we have a Monday test. What? This just isn't that hard. Okay.
Stop. I was doing fine. I was doing so fine.
Okay. Understand this. Don't ever forget this. Even when you go and take a vacation in a foreign country. When you look at an exchange rate, it's how much of their money do you get for your money. It's foreign per domestic. Foreign per domestic. Trading at 7 to 1, you get 7 of their currency for 1 of yours. Now know this, when you are in the foreign country, what is the domestic currency? Their currency. And what is the foreign currency? Yours. So you have to look at those exchange rates backwards once you're in the foreign country. I once stood behind a line at an exchange place in Mexico. And the woman looks at the sign and she goes, $321 for a peso? That's ridiculous! I should have traded all my money back home. Ma'am, don't forget.
Did they make it pay $321?
No!
That would have been funny.
What
No.
exchange rate was it back then? Jeez. When I went down there, it was like 16 to 1.
No, it wasn't 321, it was about 35. Okay, so this is 2011. Okay, so for every US dollar, you got 0.97 Canadian dollars. So the US dollar was weaker than the Canadian dollar. You couldn't get a whole one of theirs for a whole one of yours. The euro. The euro was way stronger than the American dollar. 0.71 euros to an American dollar. The yen. Yes. We're still weaker than the euro. Oh, you say yes. All right, fine. Except inflation. So, dollar for a candy bar here, 100 yen for a candy bar there. So you're still not ahead. Okay? The peso. Even the peso has gained strength against the dollar. You'd have to look it up, but I want to say that it's been in the neighborhood of 15, 16 to 1 recently. We tend to not say appreciation and depreciation. What you'll see in here most often is a strong dollar or a weak dollar, or the euro is strong, the pound is strong. We're seeing a weakening trend in the Chinese yuan. Means it's losing value versus foreign currency. If it can buy ever increasing amounts of foreign currency, it is strengthening. If it buys less and less foreign currency, it is weakening. Think of it like weightlifting. You can put more plates on, you are strengthening. If you're not able to even pick the plates up to put them on the bar, you are Guys, that is not an insignificant amount of depreciation. Almost 10% depreciation. All right, you knew this was coming. I couldn't go too far or too long without saying real or nominal.
Oh,
I thought it was practice time.
No. So, because inflation exists, we know there is a nominal exchange rate and a real exchange rate. Mom is hot.
Go for your jacket.
Mom is hot.
Oh, it's not hot.
All right. So the real exchange rate is the rate at which you trade it for the goods and services of another. What's so funny? You think I can't know memes?
No, we're talking about something that happened in English today. Oh my goodness. Sorry.
Oh,
The word was it was like English
Hitherto.
Shakespeare.
Two.
Yeah.
Hirohito.
He said and he said it so confident. He was like Hirohito and Miss
Show me
Snyder was
who.
cracking up.
So better.
My prince.
So you know his reading is perfect.
Wow.
That works.
All right.
Literally is my prince. Literally.
We all good with that equation? You think maybe it needs some explanation?
Yeah.
I think so. Stay tuned.
Ooh.
Same bat channel, same bat time.
What's
Right after the
the
break.